Treasury Secretary Scott Bessent addressing investors brewing concerns about private credit yesterday at the DealBook Summit.
I have a different worry about private credit than other people do. My worry is that in a downturn, it could be very pro-cyclical. That because it is financed by investors, if there was some kind of financial instability, if there was a downturn in the economy, Treasury through the regulators and the Fed, we can give window guidance to the regulators to loosen lending, the restrictions, the Fed can ease monetary conditions, maybe go to the balance sheet. My worry is that private credit becomes very pro-cyclical, that when you have investors in the investment business for 35 or 40 years, in your book, 1929, when you have investors as opposed to a government entity, they will always panic at the bottom.
For more on private credit risks and private wealth investments, I want to bring in Sean Connor, President and CEO of Global Private Wealth at Blue Owl Capital. What do you make of what the Treasury Secretary said?
Well, firstly, thanks for having me, Andrew and Joe. It's a pleasure to be here. Private credit, of course, has been a topic of discussion really throughout the year. We see it a little bit differently, candidly. I'd say first and foremost,
you're in the private credit business.
We're in the private credit business, so right. Obviously we see it differently. We have about half of our AUM, about $300 billion of AUM. About 50% of that, or $150 billion, is in the private credit space. I think firstly, both can coexist, right? The banking markets need to be healthy for our business to work as well. Private credit serves an important and a very different role. And so particularly around stabilization, what we've observed, particularly over the last 5 years, private credit has been a stabilizing factor. I think the fact that investors are allocating to private credit in vehicles that are long dated, right. Largely locked up for a very long period of time, very lowly levered relative to other financial institutions, it has been a stabilizing factor when the banking markets or the public markets have been less reliable. So think back Silicon Valley Bank going under, think back COVID. We were able to be there and provide capital to our clients when the public markets weren't open.
So when you hear him say the pro-cyclical nature of these things, what do you think would happen in a downturn?
Well, I think in a downturn we have seen in these kind of shocks to the systems, the investors have been there and they've stood through it because most of our clients in the wealth space and in the institutional space view these strategies as all weather. They are not looking at private credit as a trade. They're looking at private credit as a significant allocation to their overall portfolio. And they view these typically in 5, 10, 20-year timeframes. And that's the way they behave for us.
So the other person we talked to yesterday that was interesting in this, that touches in this world, if you will, was Dario Amodei, who runs Anthropic. And we were discussing sort of the how does this all pencil out? And by the way, Blue Owl is involved with this with Meta, for example. And you're seeing a lot of the big hyperscalers try to offload some of the risk of some of these big data centers and the like, using and leveraging private credit, and how we should think about that. Because interestingly, he basically said, we're making a bet here. Like, this is a big bet. We think it's going to work out this way, but there's sort of like a lot of possibilities here, and it could go another way. Obviously, everything could always go another way, but the possibilities he seemed to suggest were maybe more than in lots of other kind of scenarios.
So I was able to catch that interview, and it was very fascinating. I like the way he framed it, which was he broke it into two components. There was the technology piece, which seems like there's consensus that the technology, the general secular trend, there's consensus around that. The question is around the economics, right? And then it comes back to your point, which is the risk reward and how do you want to play this secular trend. And so we have taken the very deliberate approach where we want to be, and this is really all Blue Owl does, is we want to be on the safer part of these secular trends. We want to not take the riskier and go for the higher reward. We want to take the less risky and deliver a more stable return. And so, for example, in things we do with a company like Meta, some of the other hyperscalers, we're building the infrastructure to support that secular trend. And then we're sort of guaranteeing ourselves the opportunity for a base return based on the credit quality of the hyperscalers, who are some of the biggest, best credits out there through 15, 20-year leases. And that's the way we're playing it. So, we don't want to be in the riskier part of the world. That's not our business model. We want to be in the more income kind of rails infrastructure part of the world in the data center space. And we really do that through these 15, 20-year contracts with the single A, double A, triple A credits. And we think that'll
explain
help.
this actually. This will be helpful for the audience. For example, the deal you've done with Meta, which is down in Louisiana, is I think a 16-year deal, something on that order. But technically, they can they can walk from the lease after 4 years, right? And so then the question is, but they are still guaranteeing or making some kind of payments for the next 12 after that, but are they giving you the full amount that they would be giving you otherwise? I mean, I think that becomes sort of a larger question. I don't know. I haven't looked at the terms of how these things are structured, but I've seen people asking this question.
Yeah, a lot of people are asking the question. I'm very glad you asked me that question because it'd be helpful to clear it up. One, I think it's a good example of what we're bringing to the table. We have over 1,000 people that are building, managing for the last decade data centers around the world. So we bring to this ecosystem expertise, beyond just capital, but we also bring creativity around capital, which is helping solve the needs of these big hyperscalers. So specific to that example, yes, there's a rolling lease concept, but when the kind of the deadlines hit, there is a mechanism where we get a payment that would satisfy the leverage that's in the deal itself, but also give us an acceptable level of return. So again, that's the business model that we're trying to operate is with a credit quality as high as Meta. We want to get an acceptable level of return and not really take the technology risk or the obsolescence risk or some of the other risks that people associate with it. So it's more complicated than that, but at the end of the day, there is a mechanism where we would get our debt repaid, get a reasonable amount of return, and it also solves the needs for Meta, which is a win-win in our minds.